So I'm sure that I am not the only one who is noticing some weirdness in the market, especially over the past couple of weeks. It seems like many stocks within my portfolio and even within the S&P 500 are in significant corrections, but the overall index is still right near all-time highs. So it seems like there is a crash going on within the index, but the overall index is holding up extremely well. My portfolio has definitely not been immune from the selling that's going on within the market. So in today's video, I want to explain what is going on here, how the S&P 500 is still at all-time highs, what I am personally seeing, and also why this sell-off is happening in specific sectors and what my thoughts on that sell-off are. So this is going to be another action-packed video. Before we get into today's video, I'm happy to let you know that this video is sponsored by Moomoo. Moomoo is an international stock brokerage that has over 28 million global users across 7 countries and is an official partner of the Nasdaq. For Canadians, Moomoo offers one of the best ways to invest in US stocks. This is because Moomoo does not charge any currency exchange fees, which means you can convert your Canadian dollars instantly with no markup. For comparison, many other brokerages typically charge 1.5% for converting currency. So to put it simply, there's no cheaper or easier way to convert your currency than by using Moomoo. But besides the low fees, Moomoo has other great offerings for investors. For example, you get free access to institutional grade tools like Morningstar Research and analyst ratings, which give you the current bull and bear thesis on stocks. Normally, you would have to pay hundreds of dollars for this data, but Moomoo gives it to you for completely free. Moomoo is also running a limited time New Year welcome bonus. If you sign up and deposit $1,000, you get $60 in cash back or $300 back with a $5,000 deposit. By depositing $1,000, you'll also be entered to win Moomoo's North America Elite Trading Tour, which includes a New York VIP trading tour, new trading equipment, an iPhone 17 Pro, a $100 stock cash coupon, and V3 one-month memberships. There are a lot of prizes available, so you actually have a real chance to win. So if you're interested in investing in US stocks with lower fees and getting free investment tools, then click the link in my description to learn more about Moomoo. And thank you again to Moomoo for sponsoring today's video. Alright, so now let's hop into the video, and I want to share some screenshots of some interesting data that I have been finding in my research over the past week or so. So this first one comes from Noel Smith on X, where he wrote, "The S&P 500 is flat over the past month, but the average stock moved 10.8%. A dispersion spread at the 99th percentile over the last 30 years. But the catch is that the prior 99th percentile dispersion events have historically clustered around major market shocks, with the backtest showing ugly negative median SPY returns in the next 2 to 3 month window. So what this chart is showing us is that the average stock in the S&P 500 has moved 11%. Now that's 11% up or down, but the reason for this dispersion is because there is a massive rotation going on within the S&P 500. And this rotation is from your typical growth stocks into your typical value, safe, and defensive stocks, which I find kind of ironic, which we're going to see here in a second. But then Noel is also saying that based on the historical data, when this has happened, the S&P 500 saw a sell-off over the next few months. Now, on my channel, I really try not to predict what the overall market is going to do, but that's just some historical data for you. Now, another post on X that I found from Michael Batnick says, "Wild market. We haven't seen anything like this since the dot-com bubble burst. Over the last 8 sessions, 115 stocks in the S&P 500 have declined 7% or more in a single day. The average drawdown when that happens is 34%. Right now, we're at 1.5% below all-time highs." And then I have a screenshot of the actual chart right here, and we can see that based on history, this type of move in the S&P 500 is usually when things are being extremely volatile and the market is actually going down. And I think that this is just, and overall, I just think that it is super interesting and kind of strange that over the past 2 weeks, 115 stocks in the S&P 500 have fallen by over 7% in a single day. So there is definitely pain going on within the S&P 500. And if you're a stock picker who is in those industries, sectors, or stocks that have been being sold off dramatically, and you're not in the stocks that have seen the rotation into, then your portfolio is probably underperforming the S&P 500 by quite a bit this year as well. As I said, my portfolio has definitely not been immune. Now, this next screenshot shows us the rotation that happened in the market on Thursday this week. And we can clearly see that money is moving out of the tech sector and into consumer defensives, utilities, and industrial stocks. Walmart, Coca-Cola, Procter& and Gamble, Pepsi, and Costco were the stocks that saw a lot of inflows, and their stocks were up quite a bit on the day Thursday. If we go take a quick look at Walmart stock, we can see that it has been on a freaking rampage over the past 3 years, and it has recently started seeing a lot of buying and upwards momentum, especially since the end of January, with the stock being up 14% just in the past couple of weeks. Now, what I find interesting about this is Walmart is currently selling for a price to earnings ratio of 46.6 and a forward PE of 46.4. If we also take a quick look at Walmart's financials here and zoom in a little bit on their revenue, we can see that their top line is growing by roughly 5% annually right now. And if we take a look at their earnings, then we can see that over the past about 5 years, they have compounded by roughly 5% annually as well. So Walmart stock is selling for a 46.6 price to earnings ratio at the same time as the business is growing roughly 5% per year. This is an extremely high price to pay for a business that isn't really growing that much. If we also take a look at Walmart's valuation score here on Stock Unlock, we can see that it is deeply, deeply red, which suggests that the stock is looking quite freaking expensive today. And I completely agree with the score right here. Now let's also take a quick look at Costco. And Costco is selling for a price to earnings ratio of 54.5 and a forward PE of 48.3, which are very high multiples. If we take a look at Costco's revenue since 2020, we can see that it has been compounding by roughly 10.5%, so the company is growing faster than Walmart, which is good to see. And if we take a look at Costco's earnings as well, we can see that they have been compounding by roughly 15.6% annually since 2020 as well. So all around, it seems like Costco is growing faster than Walmart, but still, for 10% top line growth and 15% earnings growth, a 54 price to earnings ratio is extremely, extremely high. Now, the last stock that I quickly want to take a look at is Pepsi, because since January, Pepsi stock has also been rallying and is up roughly 20%. Pepsi is selling for a price to earnings ratio of 25.6 and a forward PE of roughly 19. And here we can see that Pepsi's revenue has been compounding by roughly 3% annually since 2013. But even in the most recent years right here, they've been compounding revenue by roughly 1.7%. So revenue is hardly growing over at Pepsi right now. If we take a look at Pepsi's earnings, we can also see that they have only compounded by 2% annually since 2013, and they look essentially flat over the past 13 years. So Pepsi's underlying business and profitability is not really growing at all. Now, another interesting thing about Pepsi is their sales volume has been declining since 2022, and its revenue has only been growing because it's been able to continue increasing its prices. This is not ideal at all because the underlying business and how much product it's actually selling has been declining for a couple of years now. The picture that I'm trying to paint here is that the market is currently rotating out of your typical growth stocks and into the safe, defensive, and value stocks like Costco, Walmart, Pepsi, and Coca-Cola. But when you go and take a look at those businesses and their stock prices today, they're all extremely expensive and they're not really growing that quickly. Albeit Costco is actually doing a pretty good job at growing. But when you take a look at Walmart, it's trading for 46 times earnings, and it's growing its revenue and earnings by roughly 4 to 5% annually. That is an extremely high price to pay for a business that is seeing pretty much no growth. So it's kind of ironic because money is moving from the growth stocks into these safe value stocks, but these safe value stocks actually look much more risky to me at their current prices. Like if Walmart was 10 times earnings, then I could completely understand this rotation. But at 46 times earnings, this rotation doesn't make a lot of sense. And it actually looks like Walmart is the more risky bet right now, at least in my opinion. So then the question is, why is this happening? And in my opinion, it's because of all of the artificial intelligence fears that have been coming out over the past couple of weeks. We have already seen that the software sector has been absolutely decimated. As I have said on my channel, the selling in the software industry has been completely indiscriminate. People want out of the software sector. They don't care about which stocks they're selling anymore or the prices that they're selling them at. People just want out as quickly as possible. And I think that's kind of spread throughout the rest of the market in certain industries. Like SPGI, for example. This business is arguably going to benefit from artificial intelligence, but it recently saw a lot of selling in the market because people got a little bit nervous about some new AI product that came out that could potentially disrupt SPGI's moat, or at least that is the narrative right now. But SPGI's moat is much deeper than I think people think. SPGI is sitting on a ridiculous amount of proprietary data that, in a lot of cases, manual workers, like literal people, have to go out and find that data and get that data and put it into SPGI's proprietary database. That is not data that artificial intelligence is going to be able to easily replicate, sell, and reproduce anywhere else. So SPGI's proprietary data that it spends a lot of resources gathering and standardizing and selling is a very large moat that AI cannot really disrupt or replace. But the market doesn't care right now. The market is selling off anything that seems like it could even be at risk of artificial intelligence disruption. And that is why a lot of money is rotating into companies like Walmart, because Walmart's business is pretty much clear, certain that it's not going to be able to be disrupted by artificial intelligence. Like AI is not going to recreate all of their warehouses and superstores across nations. So I think money is quite literally leaving everything that even has a slight chance or a slight narrative of being disrupted by artificial intelligence and moving into things that very clearly cannot be disrupted, like physical, very capex heavy businesses with wide distribution in the real physical world. It is wild. It is absolutely wild because the fear has gotten to a point now where people are selling fast growers that are trading for less than 20 times cash flows to go and buy extremely expensive businesses like Walmart that are growing 5% per year and trading for 46 times earnings. That shift is completely emotion driven, in my opinion. And I also think that it is starting to create opportunities in the market. So I want to show you some more quick charts regarding software companies as a whole right now. So this first one shows us that global investors are leaving software and the exposure to the sector has been tanking. It peaked at roughly 25% exposure in 2022, and now it is down to under 10%. And again, I have been saying that the selling in this space has been indiscriminate, and I think that this chart clearly suggests that. Now, what's interesting is this next chart shows us the revenue of the enterprise software companies that are publicly traded, and their revenues are all clearly continuing to grow, and it doesn't look like they're being disrupted at all. Now, I understand that the market is forward-looking, but the sentiment is that all of these businesses are disappearing and that their fundamentals are going to start declining tomorrow. But what I have seen from earnings reports so far is that AI hasn't truly impacted any software company in a massively negative way yet, and earnings have still been strong across the sector. However, I personally still do not think that every software stock is a buy or even that cheap today. And I do think that AI is a real risk to some of these businesses, but not all of them. Joseph Carlson put out a very good tweet today that I wholeheartedly agree with. So in this tweet, he says, "The tariff war was a scare that I thought was mostly superficial and a dip worth buying. I made it public to buy the dip. Silicon Valley Bank was another scare that I thought was short term and another easy dip buying opportunity. Netflix being killed by Disney Plus and HBO in 2022 was another narrative I did not believe and continued buying Netflix. ChatGPT killing Google search was another narrative I didn't believe, but I continued buying Google. AI killing software companies is a dip that I've given much greater respect to and has not been as flippant or black and white about, because I think there's a lot of truth to it in this narrative. A lot of legacy software companies offer old and very expensive and frustrating products that many businesses have been dying for a viable alternative. If AI provides a viable alternative, they will leave. The sell-off is probably overdone, yes, but I still believe investors should audit each potential company and be highly selective with what they buy, avoiding the companies that have products that are easiest to displace with code. I bought more into it. It's the lowest valuation in over 10 years. It operates in a highly regulated and compliance-heavy industry, and I think it will be one of the most difficult for AI to threaten. But even now, I am buying it with caution." So what Joseph Carlson is saying here is that the other dip buying opportunities that were presented in the market were very clear dip buying opportunities, like the tariff crash of 2025. When the market dropped, I think it was something like 20% rapidly, that was such a no-brainer, clear opportunity to buy stocks because it was driven by one man who could easily reverse his policies if he chose to, and then everything would be fine. So that dip and many other dips were very clear buying opportunities. But this downright crash in the software space, I also think isn't nearly as clear because artificial intelligence is a very real threat for a lot of software companies. And the reality is, we don't know for certain what artificial intelligence is even going to look like within the next 5 years. Many of the software leaders that I respect and listen to, like Mark Leonard, have made it clear that they don't know what the future of software is even going to look like. They believe that right now, their businesses can benefit from artificial intelligence, but they're also not trying to lie to anyone and say, well, yeah, we know where this technology is going to be in 5 years. So I think that the future of the software industry has never been more uncertain. And I have even said to my audience before that if Constellation software got down to the right price, I would make it 25% of my portfolio. I believe I said that sometime in 2022 or 2023. And I have now been asked about this quote before, and also been asked why I am not plowing 25% of my portfolio into Constellation software. Because the current Constellation software family, which is CSU, Topicus, and Signity, those are the stocks that I own, is roughly 7% of my overall portfolio right now. And the reason that I am not making these stocks 25% of my portfolio right now is because I fully admit that the future of software is more uncertain than ever before. It is not the same industry that it was 3 years ago. And a lot of these companies and stocks were priced for perfection just back in 2025. So I do actually think that some of this software sell off has been justified because they were priced for perfection and like they were going to continue printing cash forever, like literally trading for 35 to 50 times free cash flow. And now I think that a lot of the software companies are priced a lot more appropriately and discounting some risk in the future. Another good example of times changing is I was purchasing Adobe stock in 2022 on the crash that the stock saw after they tried to acquire Figma. I then sold the stock sometime in 2023 for an 80% gain because I thought that it was getting expensive again. But Adobe stock is now down below my initial purchase price in 2022, but I am not actively buying Adobe stock. And this is because I think Adobe is one of these software companies that is more at risk of AI disruption. So things in the software industry have simply changed over the past few years, which has now caused me to reassess some companies and reassess the overall exposure that I want to this industry while its future is more uncertain than ever before. Now, in regards to why I am getting more bearish on Adobe as time passes, is because a lot of very, very good AI generated content is continuing to come out. This video right here that is playing on your screen right now was generated by Cdance 2, which is a Chinese video generation model, and it is a replica of the Titanic. This clip isn't real from the Titanic, but you can't even really tell anymore. This next clip is Godzilla versus King Kong, and just look at this. Like, this is incredible, and it's completely AI generated. This next one is Spider-Man versus Venom, and obviously the AI is not perfect, like the spider web just went through Venom's head right there, but it's getting pretty dang good. And imagine where this technology is going to be within the next 5 years now. You can also obviously tell that they are breaking copyright laws and this can't go mainstream, but you can also see that the AI generated content is getting very, very good. And I've also seen other 3 to 5 minute AI generated videos with storylines, and they look pretty good. So how does this all impact Adobe over the long term? I really have no idea. But I do think the barrier to entry and the need for editing software overall is going to decline. Or in other words, I think Adobe's total addressable market is at risk in an AI-generated content world. However, other companies like Meta are actually benefiting from AI-generated content. And this post on X from Mindset for Money CPA says, a revenue stream that should not be overlooked for Meta is ad video creation within the platform. They not only want you to run their ads on the platform, but they want you to generate your ads with them too. 10 billion in run rate in the fourth quarter is quite incredible, especially when you consider the revenue stream is brand new. Providing an outlet to create your ad media within the platform lowers the barrier for video creation and ultimately expands their moat as an advertiser. Mix this with their agentic shopping, and it is not far-fetched to say that Meta could become the greatest advertiser in the world. And this is coming from a Google shareholder. I've said this many times, but Meta is actually one of the companies where heavy investments in AI make complete sense and will result in strong ROI. So Meta is successfully generating videos for customers and benefiting from it. And think about this. Meta could be able to generate multiple video ads for your business, test them in real time, and see which one works the best and gets you the highest ROI on your ad spend. So Meta is taking away the need for the customer to even do their own content creation or hire a team to do so now. Content creation coupled with ad automation is the winner. And Meta has the data and the distribution to win and offer significant value here. But you can see the overall point that I'm trying to make. Not all software is a winner in this AI generated world. Now, this next screenshot comes from the Airbnb CEO and what he said in yesterday's conference call. And here he said, but the other thing to know, and this is the most important point, is that these models are not proprietary. The model ChatGPT, the models Gemini, the models Claude, the models like QE are available to every single company. We will be able to do everything everyone else will have if we use their models, and we believe specialization will win in travel. A chatbot doesn't have our 200 million verified identities or our 500 million proprietary reviews, and it can't message the host, which 90% of our guests do. They can't provide global payment processing, customer support, or insurance, and by layering AI over the entire event experience, we believe we're building something that's impossible to replicate. So what differentiates your business in this new AI-driven world is the proprietary data that you feed the AI. Airbnb has the verified network and the ability to message hosts, which AI won't be able to do without access to that network. And that gives Airbnb its competitive advantage over a brand new AI startup. HSBC analysts also wrote their thoughts on artificial intelligence. And here they wrote, in most cases, AI's usefulness in the enterprise without software is limited to a few special cases: image, video, code generation, apps, and chatbots. But in order to maximize AI's usefulness within the enterprise setting, AI and software need to work together and leverage each other's strengths. We see AI as being more of a learning algorithm than software or an application, and see software as being more of an execution machine than a thinking machine. Each has its plate, and together they are stronger. We believe that the vast majority of enterprise software will not be threatened by AI, but rather that AI will be domesticated within the application stack via agents, and will create significant value in doing so. We have identified a party that is best suited to use AI to generate software that is better than existing legacy vendors. And of course, that is the software vendors themselves. They have the domain expertise, robust sales channel, trusted relationships, cross-licensing, and legions of coders that are now more productive at creating new code by using AI apps and tools. So HSBC analysts believe that AI and software will work together to bring out each other's strengths, and that AI will be the learning and automation layer on top of the data and software layer. AI isn't as useful on its own without that software and proprietary data that companies have. Therefore, AI allows companies with the software and the proprietary data to fully unlock their value for their customers. And that is also what the Airbnb CEO is just saying. All of these reasons are also why I think Constellation Software and its family of stocks will benefit from artificial intelligence and not be disrupted by it. So all of this is to say that I do believe that there are opportunities in the software industry, and that artificial intelligence is not going to completely disrupt every single software stock. However, I do believe that there are software stocks and businesses out there that do run the real risk of having AI disrupt their businesses or their total addressable market as a whole. So while I do believe that there are opportunities within the S&P 500 and especially in the software sector right now, I don't think that it's like shooting fish in a barrel. And I think investors need to try and be objective and ask themselves which stocks are actually going to benefit from AI and which ones truly do have the risk of being disrupted. And as I have shared on my channel previously, Constellation Software and that family of stocks are the ones that I think will be the most immune from artificial intelligence disruption and have the highest chance of benefiting from AI overall. But with all that being said, that is going to wrap up the video for today. And that is what is going on in the market, why the S&P 500 is at all-time highs, despite certain stocks seeing downright crashes and a correction going on within the S&P 500. I also wanted to provide you with some more of my own AI research and what I'm seeing online, so that you can better identify which companies and which stocks could be disrupted and which ones are most likely going to be more resilient. So I hope that you enjoyed this video, and if you did, then please remember to leave a like on it. And if you're not already subscribed to my channel and you want to see more content like this, then please consider subscribing to my channel as well. And as always, thank you so much for tuning in. I truly do appreciate it, and I hope to see you again in my next video.